Sailesh Raj Bhan, President and Chief Investment Officer, Equity Investments at Nippon India Mutual Fund. Mr. Bhan, thank you so much for taking your time out and joining us here on ET Now. Last year, same time, had you invested in gold, you would have probably made more money than equities, isn't it? Do you expect the trend to change this year?
See, anytime where such good returns are made, I think you have to asset allocate. I think you have to look around and search for better ideas or better price segments of the market. And I think we've seen a fantastic run in gold. To expect that kind of a shift next year is very difficult. It's very difficult to predict those. But I think other segments which have become far more sensible, like equities, haven't delivered in the last 12 months so much. And I think valuations there are getting a little more sensible than they were before. Those are opportunities which present today. So I think, chasing, possibly you do true asset allocation and then balance the asset allocation when extremes happen.
So, Mr. Bhan, you believe that equities, because of the way they have corrected and the kind of valuations that have come down nominally, do you believe they're now attractive enough for a fresh round of upsurge in the market? Because take a look at the Nifty 50, 2-week high is where we're seeing it right now. And I don't only mean from a retail investor point of view. What about FIIs and them making a comeback? Is that something you're seeing meaningfully in the next month?
See, in the markets, nobody really matters, what type of an investor is putting money. What really matters is what is the construct of earnings and what are we paying for those earnings. So today when you look at it, earnings have been weak for the last few quarters, right? And they're likely to get better because of all the good things which have been happening, whether it's GST, whether it is rate cuts somewhere, whether it is tax savings which have been coming about. And the base of earnings has also been low. So you'll now see more consumption-driven growth recovering in addition to just infra and investment working. So many things are working in favor. And I think you'll find that the price correction, the valuation correction also presents decent opportunities here. To your point on flows, right? Flows matter for some period of time, right? I mean, if I told you 3 years back that FIs would have been selling this much and our markets would be up, it would be very difficult for us to judge, right?
True.
So I think the real judging point is clearly that, you get earnings reasonably right, at least the trend of earnings reasonably right, and then participate for some period of time. But I still would not use the word you used, upsurge.
Upsurge?
We would just talk about we're just seeing that, sensible compounding is possible and earning-led returns are possible in equity markets.
And since we're talking about earnings growth, what kind of earnings growth are you penciling in for FY26? And will low double-digit growth be a fair estimate as far as earnings is concerned for FY27?
Yeah. So FY26 has already been 2 quarters are more or less through and it's been modest. So there's some improvement in second half based on GST effect and tax savings which come about. FY27, when other sectors also start contributing, we can enter into 13 to 15% kind of growth, which is generally our long-term potential growth. So that kind of 13-15% kind of compounding from there on is, at least at the moment, based on the construct, is possible.
Okay, so that at least sounds optimistic and the next big thing to watch out for in terms of where the market could be heading. But Mr. Bhan, help us understand, you did say that the next round of rally, or at least the next leg of the market, could be driven by a consumption-led boost. Within the overall consumption basket, where would you be, positive on? Where are you constructive? Because you have autos, discretionary, consumer durables, staples, so much is there within that big basket. Any micro basket that you are liking right now?
So the larger baskets, auto has done reasonably well already, right? But I think given these GST savings, actually, I think they'll benefit for 4 years because the pricing of the product will become attractive and more consumers can come into the consuming side there. Other areas like, staples and consumer discretionary haven't done so well. Staples have not done well for a long time because their starting valuations were very, very high. And durables have not done well, at least for the last 3 years because of the weakness in both rural and urban incomes in different phases. We think both of these segments are now getting sensibly priced for growth and general expectations, at least in staples and all that, is very low. Today nobody talks about the consumer sector growing at higher than single digit and things like that. I think earnings surprises will happen in some of these spaces. And a lot of people, a lot of companies who have not invested for growth in the last 3, 4, 5 years, I see them being more focused towards getting growth right. Earlier they were focused on getting margins only right. So I think this should help recover in demand and volumes.
Understood. So that's as far as consumption is concerned. But any other mega theme that you're spotting in the market right now which could be multi-baggers for the next 3-5 years?
See, there are no easy multi-baggers left. I mean, it's been a fantastic bull market till now, so there is no easy multi-bagger left, right? there's some of the good quality new age companies where they have built a right to win, and they would actually be very large opportunities to win from. And there is a set of companies which are now a little forgotten blue chips kind of thing. They have done very well for the last 1.5, 2 years. And I think again they have an opportunity to do well. But multi-baggers are not today easily available in markets. I think they will come with a lot of disruption or possibly after a large correction.
But what about AI as a theme? Is that a theme that you're betting big on? Because sooner or later, our companies back home will have to inculcate AI to become competitive globally. So on the back of that, your view on overall IT and AI as an emerging theme?
So AI as a theme will matter. I think it's getting material globally. It will become important to us in different ways. But the way to play in India would be possibly users of AI who are using it very efficiently and driving their businesses. So as always, we've never been able to build very large product-oriented businesses in India at the moment, at least not in the listed space, right? So I think the best users and efficient users of tech who can actually drive down and maybe get the revenue side right using tech, using AI and all that will be very, very useful. So more consumer-led companies who can use AI to their advantages will be beneficial, in addition to power and all these areas which actually feed into that side of it. You talked about IT services, right?
Yes.
I think it's actually more IT services than tech in the context that they are more in solving solutions for global businesses, right? There, I think clearly there has to be a re-engineering and there has to be a complete shift in terms of how it is being approached. They have been very successful over the last few decades to manage shifts. But when you're going through a shift, you certainly go through a slower growth rate. And that, I think, things are happening for them in that particular fashion. So it's possible that some of those large IT services businesses will have to totally re-engineer how they are looking at approaching it, productivity per employee, and a lot of things might need a change.
And since I started by asking about gold, let me ask you, after the kind of run-up that we've seen this year so far, do you expect the momentum to continue, or it's better to be cautious now?
See, gold, or most asset class move in phases. I mean, what gold has its golden phase today, to put it like that. And so it's very difficult to predict how they would do. But ideally, when you're doing asset allocation, right, the purpose of asset allocation is to get these calls right, which you can't get it right every time. So probability of that being there. So now when you have within asset allocation, gold being a larger portion now because it's done 50% versus other assets which have not done so well, it is possibly the time to start looking at doing reallocation to asset classes which are better priced. I think the true thing of asset allocation is to rebalance sensibly over medium term. And I think those opportunities come up when you have these frenzied rallies in gold and silver, and when you're getting people talking about crazy levels of prices in the future. None of these guys are projecting it a year or two back, right? So that's the opportunity where you reallocate some reallocation is warranted.
So gold versus silver, if you have to pick one for the next summer.
It's very difficult to pick between these two, because I think most of the driving force for their returns are common. I mean, they come with a little lag, but it's relative asset pricing which is there. And it's very difficult to pick between one of them, right? And I'm saying all these have a role to play. Don't see them as investments from meeting a particular goal at a particular point of time. See them as risk management within your portfolio, where you put them as important assets. Which so in these times, for example, you have actually outperformed equities by 40-50% being in gold and silver in a year. So it's possible that 10-20% of reallocation back to equities is what should be the strategy for it.
All right, and coming back to equities then, from a valuation standpoint, what will your view be on the Indian market be, especially because of the underperformance that we have seen?
Yeah. Interestingly, we are in much better phase. We were in a proper bubble phase last year. Like last time, same Diwali time, I think that has gone through material sensible correction. Large caps have moderated by 7 to 10%. Indices might be flat, but earnings have been 7 to 10%. So there's some derating. A lot of events have happened, which are like the GST cuts, the tax cuts which the government has done, right? And also possibly we are seeing the worst of global condition also hopefully getting behind. And it's very difficult to predict, but that also is possibly. So in 12 months out, when you're looking at a reasonably good picture out in terms of how the world might be and how the valuations now being sensible, I think it's a good opportunity there. So large cap valuations are very sensible today. I think earning-led returns are possible there. The other segments of the market, the mid caps have also seen some correction, not to the extent of small caps, but they have also moderated a bit in terms of expectations. And small caps have also seen reasonable corrections. In fact, a lot of subsegments of markets have corrected 30%, 40%. And today you are able to go around and try to get some of these ideas you can really buy. Last year, virtually there was no idea to buy. Today there are maybe 10, 20% of the part of the market which is getting sensible. So I think more time correction is possible in some of these segments. And but it's much better than what we were 12 months back for both large, mid as well as small caps.
Mr. Bhan, as we wrap up very quickly, one sector you'd bet on for the next somewhat and one sector you'd absolutely avoid.
So pharma for the next year is a sector which we bet for, and industrials I would avoid for the next 12 months.
All right, so some good wealth creation ideas coming in for our viewers. Mr. Bhan, thank you so much for taking your time out and joining us here today on ET Now.
Diwali as well, so let's welcome on board Karthik Kumar, Fund Manager at Axis Mutual Fund, and figure out what he's making of the market right now. Karthik, festival greetings firstly from all of us. Thanks for your time today. What's the market looking like?
Firstly, thanks for having us and wishing you all a very happy Diwali as well. I think the markets are at a point where we've seen time correction over the last 1 year. And I think that was much needed after the rally that we've seen over the last couple of years. So I think a large part of the time correction we've already taken. I think going forward, there are a lot of green shoots that we are seeing in the markets. If I were to break it down, primarily I would look at it first from an earnings perspective. So if you look at it from an earnings perspective, what's happening is we've taken the bulk of the earnings cuts at the beginning of this financial year, partly due to events like the fact that we had a war with Pakistan, the fact that we had tariff-related issues. So we front-loaded a lot of that earnings cuts. So if you look at the upgrades to downgrades ratio, which was significantly negative 2-3 months back, now it is pretty much flat. Then the government is trying to put a floor on those earnings, essentially through all the actions that they've taken through a combination of what RBI has done and what the government themselves have done, with the GST cuts being the latest round of incentives there. So the government's trying to do their best there. And lastly, if I look at it from an FII perspective, while they've they've been selling through the year, things are changing over the last few days. But also what's happened is through this time correction, our earnings premium or discount, PE discount to emerging markets has kind of come up substantially from almost, we were up 1 standard deviation away, now we are almost on par with emerging markets. Plus the fact that central banks across the world are turning much more dovish. So that should help emerging markets in general. But the fact that we've kind of lagged through this rally, I think there's a good chance that if the earnings turn around, and when they do, we will see some support from the FIs as well, because that's what happened the last time around in that cycle.
Karthik, you handle quant strategy at Axis. Tell us how you operate, a certain sense, and tell us how we're set up. What is it that you're liking in a market like this? Let's start with that, and then maybe come to the dislikes.
So essentially, in a quant strategy, just to kind of be brief about it, we look at different styles of investing, and then let the model do the talking in terms of a systematic process. And what we've seen so far this year, which is quite interesting, is that if you look at the styles that haven't worked this year, so none of the frontline styles have actually worked, which is growth, quality, momentum. None of them have worked. Value has barely managed to keep pace with the benchmark. The only style that has actually worked is the low vol. Stocks with low volatility have done really well. So that is how the lay of the land is in terms of the year so far. But if you ask me, it cannot be that the market continues to ignore the fundamental styles or the fundamental inputs. And so, which is where I think as the earnings trajectory kind of stabilizes and we start seeing earnings improvements, I think from there on we will see some of these styles being the focus of the market going forward.
Okay. And what are you liking in terms of sectors? What are you buying at this point? How is let me put it this way. How is the evolution of the market impacting what you're putting money and where you're taking out money from?
So we've, even prior to GST cut announcements, and we've been bullish some of the structural themes like, let's say, tourism related plays. We've been bullish on power T&D related plays. So those are themes that we've been consistently positive about. Since the last round of, let's say, GST cuts and income tax cuts prior to that, what we've done is we've increased our exposure to autos. We've selectively taken exposure to more autos, and also now more so also in the consumer staple space, where we are seeing earnings upgrades, we are seeing earnings revisions. So all those things are kind of helping, driving us in that direction as well. So aside from the couple of sectors I mentioned, we are also bullish financials across the space, the entire space, be it PSU banks, private banks, select capital market plays, and I'm also bullish on, as I said, select capital marketplace, and so those are the areas where.
Why select capital market spaces? Because I mean, it's supposed to be the decadal structural theme, and it's really a basket approach that, at least that was advised till about 2 years back. So what's not looking attractive, or what looks priced to perfection?
I mean, it's not about not looking attractive. As you said, it's a decadal theme. But at the end of the day, valuations do play a role, and there's a cycle in all of this. While I might not be able to comment on stocks, yeah, so it's right now I have more exposure towards asset management companies rather than some of the other plays. But I completely agree with you that it is a much more structural theme, and there is a long way to go in terms of the story.
You also talked about your interest in telecom. Given how limited the pool of the listed plays within telecom is, and even counting the ancillaries, what is it that's looking like there's still value on the table when it comes to telecom, or is it just a function of the duopoly in the market and you play on that?
It's fair. It's part of that is a function of the fact that it's a duopoly, and there's a play on that, and also there are drivers for that particular space as well, in terms of we expect the earnings growth in the telecom sector, the free cash flow in that sector to be fairly strong. And in that context, given where we are in the market, I think that makes it an interesting space to deal with.
Do you at all keep cash in the portfolio, Karthik?
So in terms of the process within the quant portfolio, typically I keep only limited amount of cash, don't take cash calls. Largely the portfolio is deployed. The idea here is to look at opportunities within market, kind of exploit the spreads and exploit sector and stock level differentiation, play on that rather than take market calls. So
sure. And auto, give us a sense. How quickly did you get on the bandwagon? Because the move has been swift. And what do you do now when something has moved up so quickly? What do you do next?
So we did have some exposure to auto even prior to that. So it's not as if we had no auto exposure, but since the day of GST cuts, or the announcement of GST cuts, what we've done is we've added more exposure to some of our stocks that we already owned. And mind you, this is all coming from a quantitative process. It's not subjective in that sense. And if I look at the names that we are in, those are typically the market leaders in their space, be it two-wheelers or four-wheelers. So looking at market leaders in that space.
But you continue to hold them. You don't intend to at some point of time switch from auto to something else, because of course you don't take cash calls. So you need something else in the bag to move out of auto.
Exactly. So we need a sector or bunch of stocks, because it's bottom up. We need stocks where we can see positive earnings drivers. But as it stands right now, we are in autos and staples and discretionary stocks, we are seeing positive earnings revisions. As the festive season plays out, it'll be interesting to see how strong it gets and look at the data therein and then kind of make that decision.
When it comes to staples, is it largely the GST and the income tax benefits, and is that the play, or and more of a bottom-up story, not looking at valuations right now, because traditionally they do trade at high multiples?
There are two ways of looking at. Yes, they trade at higher multiples, but those multiples have kind of compressed through time. So one could make the argument either ways. But on an absolute basis, yes, they are trading at a premium to market. But the larger thing that is driving right now is the GST cuts and hopes of a revival in their earnings trajectory over the next couple of quarters.
And how do you play? It's a fast evolving environment, right? So how do you play that? Because that also presents some opportunities, but also comes with its set of risks. Do you believe that the worst in terms of the global macro as well as tariffs is behind us, and are you playing more aggressively on those areas of the pitch as well? Something like a pharma, something like a textiles, something like an IT. How do you play that?
So I continue to remain underweight IT. That's because firstly there are areas in the market about the sectors I touched on where earnings visibility is higher, the growth rate is higher. So as compared to IT, where both visibility is there is not as much visibility as with some of the other sectors. So we continue to remain underweight IT. With regards to some of the other sectors that you mentioned, as I said, it's a data-driven process. So as and when we see clarity in data and we see trends improving in those sectors and subsectors, I'll be happy to change my call.
Is there a play on flows within the data that you analyze, and how much of the FI flow versus the DI do you play, and how do you play that?
So there is an aspect of flows, but it is not as much FIIs versus DIIs. It's a slightly different aspect that we are looking at. At the end of the day, what the model looks at what is the growth opportunity in terms of forward-looking parameters, look at other areas like quality, valuations, and so on and so forth to make a bottom-up decision. So it's not as much FIIs versus DIIs, and it's more about where the opportunity set is.